Welcome to the Real Estate Investing Failures to Fortunes podcast, the show where we fearlessly dive into the untold stories of real estate investors' greatest setbacks and how they turned those failures into resounding successes. I'm your host, Kate Berry, and we're talking with real estate investors across the country to learn exactly how and why they failed, and how they took that failure and turned it into a powerful lesson for their business. So come along with me, Kate Berry, on this transformative journey from failure to fortune. I invite you to join our supportive community where together we can inspire, educate, and motivate each other to achieve all of our real estate investing goals. Welcome to the Failures and Fortunes podcast. I'm your host, Kate Berry, and we are here today with Gino Barbaro. He is a multifamily educator, investor, and operator with over $350 million in assets under management. As co-founder of Jake and Gino, the premier multifamily education community, he focuses on his students' results and growth. To date, his students have closed over 76,000 units and have $5 billion in deal volume. Gino also co-authors best-selling books, Wheelbarrow Profits and The Honeybee. He resides in St. Augustine, Florida, with his beautiful wife, Julia, and their 6 children. Gino, thank you so much for joining us today.
Thank you for having me on, Kate. Good morning.
Good morning. That's a great intro. You've got a lot going on. It sounds like you have a great deal of experience. I would love to hear about how you got started in real estate.
I didn't get started in real estate until, I guess, a little bit older in my life. I went to college. My parents were both immigrants from Italy, and we opened up a restaurant. My dad was in the restaurant business, and I opened the restaurant way back when I was 22 years old, and I had worked that restaurant for a good part of my adult life. In 2007, my father passed away, and I sat there wondering, am I living his dream or am I living my dream? And I felt as if I was living his dream because I had grown up. I was 9 years old. I was going to work with him. I loved being in the kitchen with him. I loved having him as a mentor, a role model, having him teach other people how to cook and how good he was, what he was and what he did. And that translated into my life. And in 2008, the Great Recession happened. And I said, I've done a couple of real estate deals. I made some big mistakes. I'm working a lot harder, making less. People's appetites are changing for food. I mean, people want delivery now. The margins are less. And what everyone else is going through. And I decided, let me get into this multifamily thing. How do I get into this? I knew that I needed to get educated because education times action equals results. And I was taking massive action without any education. Made a mistake on a couple of big deals. We'll talk about that later. But that was the start. And then I was fortunate to meet my business partner, Jake. He was a pharmaceutical rep taking food orders out of my restaurant and bringing them to doctors' offices. 2009, we meet. He moves to Knoxville in 2011. And 18 months later, we're looking for deals. We finally closed our first deal together in 2013.
Nice. Wow. I resonate so much with your story. I also grew up in restaurants. My parents had a catering company. That is a great foundation to learn how to work hard, deal in high stress situations, and deal with all different kinds of people.
Yes.
Right?
And I don't want to insult anyone listening to this, but if you're going to Starbucks and you're whipping out your laptop and you're working, that is work. I'm not going to deny that. But I would like for you to be on your feet for 11 hours in a kitchen that's 115 degrees, having people yell at you because their food is 2 minutes late and having to push out 300 orders and then say to yourself, I've got to do that every week and there's no end in sight and I'm on the hamster wheel. That will build a little bit of resilience in you and you're just conditioned to work really hard. So always appreciate what you have. I'll give you another quick story, Kate. I was doing my roof a couple of weeks ago in Florida, metal roof. To see those guys sitting on the roof up there in 100-degree weather, risking their lives and limbs strapped to a rope and thinking that, I've got to get on a podcast today. That's hard work. Right. Just appreciate what you have because there's a lot of other people out there that are doing jobs that they don't like or that are a lot more difficult than what we're doing.
Absolutely. When I transitioned from restaurant world into real estate world, I met a lot of real estate agents that were like, this job is really tough. It's so hard. I'm like, I'm sitting in an air-conditioned room. I have my lunch. I get to sit and eat it. This is
Yes.
not hard.
Yes.
This is not
Yes.
hard work. It is hard. Of course, we've got the ups and downs of real estate. And I think it's so interesting. I've noticed a pattern. A lot of the folks I have on my podcast obviously reference 2008 because that was a great transition in the real estate world that changed real estate forever. And you got started in that world and had your first deal closed in 2013. Right before we got started recording, we were talking about market cycles, right?
Hmm.
Can you tell us a little bit about what it was like to 2008 to 2013? That's 5 years to get that first deal. What was that like for you?
It was a struggle. I read the book by T. Harv Eker, The Secrets of the Millionaire Mind, in
Mm,
2008. And that's what really precipitated my whole personal growth journey. When T. Harv Eker in that book says your fruits are in your roots. And
mm,
I've got to be honest, my roots were pretty shallow. And if you have shallow roots and you don't know how to provide value and you're not valuable to the economy or to the marketplace, your fruits ain't going to show. That's the reality. And I had to bite that bullet. I had to have to come, as they say, come to Jesus moment. And I
yeah.
had to get really responsible with where I was. All the actions that I had preceded my life to that point got me to where I was. And I was unhappy where I was. And most of us can become victims and we can start blaming other people like I did. It was the
Mm,
economy. It was the '08 recession. It was Bush. It was Obama. Whatever you want to blame, I'm not saying you're right or you're wrong. But when you have that victim mentality, you don't have the ability to create opportunities or to look for solutions. And when I read that book, there were solutions in that book. I need to take responsibility. So the next step I did was I started researching. I started joining mentorship groups. I started investing in my education. And then I had the ability to go out and talk to people like Jake and my future partner, Mike, about real estate. Luck, hard work, and luck. If I hadn't put in the hard work, I would have never have gotten lucky. And it took a couple of years because of the limiting beliefs. Oh, the economy is terrible. Real estate is risky. Interest rates are high. You can't raise money. Does that sound familiar? It sounds like we're in the same pattern as we are now. And that's why it took me a lot longer. I mean, obviously, Jake moving down to Knoxville, me learning a new marketplace. In 2011, you have Stenziano
mm.
and Barbaro, two Italian guys from New York trying to buy in Knoxville, Tennessee. When you hear y'all ain't doing business, that's a real thing. At least back then
Right.
it was. And it took us 18 months because we did not know what we were doing. We didn't understand that Kate, the real estate broker, she's the gatekeeper. She's got the deals. Let's build
Yeah.
rapport with Kate instead of beating Kate up. It took us a little while to figure that out. And fortunately for us, we did. And from there, after that first deal, 3 months later, we actually ended up signing our second deal.
Amazing. You know what I'm hearing you say in that is real estate is about the relationships.
Hmm.
And especially when you're working in a new market or as a new person, there needs to be respect is given when respect is due, right?
Hmm.
So when you have to understand the dynamics about real estate, yeah, there are people that hold the keys to what you want.
Absolutely.
They're not gonna give it to you. Yeah, if you're beating them down or telling them to, you have to provide that value. You have to bring something to the table, and then suddenly
Hmm.
more doors open for you.
Kate, it's important in multifamily. If I want to find a deal, the first thing I hear from newer investors is, I need a deal. I want a deal. Kate, do you got any deals for me? Kate's going to look at me and say, are you nuts? First of all, what is your credibility? Second of all, you sound like a new investor. Third of all, what's a deal to you? Can you
Right.
give me some buy right criteria? Can you give me an understanding of what you're looking for, a little bit more specific? And that's where we go wrong in multifamily, and especially in investing itself. We don't have clarity. We don't understand what our goals are. And that's why you'd asked a great question. I should have expanded upon it a little bit. Jake and I didn't really know what we were looking for. We
Mm.
didn't know how many units we could buy. We were really focused on the market. We didn't understand median income, a buy right criteria. We had none of that in the very beginning. That's why it took us a lot longer. And once we figured it out, all of a sudden we're focusing on it and we're talking to a lot more Kates of the world. We're able to express what we want. And then Kate will call up and go, hey, Gino, I've got this 30-unit property. This is perfect for you. You're looking for 2 bedrooms. You're looking for a $50,000 median income. It's got washer dryer hookups. It's in the south part of the city. You're going to love this deal. Oh, well, that's the deal. That's how you become successful in this
That's
business.
right. Because as the broker, that's what we're doing. We're brokering the deals. We're putting together buyers and sellers. So
Yes.
we're putting together buy boxes with the criteria of the property. That's what we like to do. And if you're coming
Hmm.
to a broker saying, I want a deal, you're basically saying, I have
open criteria. So we can say, okay, then there's thousands then,
Yes.
but you can't fit into every single one. And you're going to actually, what you're asking me to do is spend a lot of time and energy on you. And there might be something in it for me at the end of the day, but it's not really guaranteed. And while at the same time, I have 10 other investors knocking down my door, asking me for my resources and my connections and my deals. So
Yes.
I'm not going to give you that time, right? Unless you're coming to me saying, here's what I've got. This is what I'm looking for. I'm going to make your job easy by lining it up for you. And then I say, okay, great. And then I can start sending you a few things here and there. But, you have to understand, again, it goes back to that respect when you're going into a new industry, a new market, and people that have been doing this for a long time and are very successful at it, they do have those keys, but they're not just going to give it to you.
That's right. I agree.
So let's go into, we're the Failures to Fortunes podcast. I'd love to talk about that. There's one deal you had outlined before we started talking that was a moment for you, a hard deal, a tough one that you lost some money on. Let's get into it. I'd love to hear more about that.
Yeah, I'd love to share my very first deal. As I'm reflecting upon what's going on in the market, I think my very first passive deal is so much more appropriate than the second one because right now you're hearing in the marketplace a lot of these operators or sponsors or these big groups that have raised capital are starting to have capital calls, and people who invested passively are starting to lose money on these deals. And a passive investor is blaming the operator is blaming the market, where ultimately I learned the hard way that it's ultimately my mistake as a passive investor. And it was my very first passive investment. I had a gentleman named what I referred to him as Maserati Mike. He drove into my restaurant parking lot with a nice, shiny gold Maserati. He was referred to me by a friend. And Maserati Mike said, Gino, I'm in the mobile home park space. I've got some mobile home parks. You want to invest with me? Now, I didn't understand that he was pitching a syndication. A syndication is basically he's creating a security because as a passive investor, I was giving him my money in exchange for not doing any work. He was going to sponsor the deal and do all of the work. So in effect, he was creating a syndication, a security. I got no paperwork. I had no idea what a syndication even was. That was strike one. Strike two was I didn't know the mobile home park space at all. Strike number three, I didn't understand the word due diligence or underwriting. There were so many mistakes that I made. They always say a person with money meets a person with experience. The person with experience gets the money, and the person with the money gets the experience. And that was me to a T. Now, I can blame Maserati Mike for being a buffoon, for really just not knowing what he was doing, for losing my $172,000. And I did for a little while. Yeah,
That hurts.
it does. The sad part was I invested in one deal. I was getting checks for about 5 or 6 months. And between that time, he found another deal and I invested in his second deal because I thought this is going to be great. I'm passive. I'm too busy working at the restaurant. I'm just going to give somebody my money. So
Right.
before you do that, I would say it was very easy. If I understood how to look at these deals, I would have said no to him in 30 seconds. If I had just gotten onto a plane, flown down, looked at the properties. If I had a coach look at the underwriting that was presented to me, they would have said, this is not going to work by a long shot. But I didn't do any of that because I was too busy, right? So I would tell anybody, if you're going to invest passively in real estate, it is an amazing way to get started because you're busy. You're brokering deals, you're performing surgery, you're in the courtroom, your bandwidth is limited, but you want to invest in this amazing vehicle, invest passively, but learn how to invest passively. And I wish I had learned to invest passively. And after about 18 months, those deals ended up blowing up. He foreclosed. He had no skin in the game, so he lost no money in the deal. What he lost, and Kate, that's another mistake. I would love to go through the framework for passive investors because I think that'll really help anybody looking at a passive investment and saying, how do I give money or how do I partner with somebody? I think the first thing you really need to do when you're approached by a Maserati Mike, we call this our 3-step framework. The first thing you need to look at is we call it a jockey, a saddle, and the horse. Those are the 3 steps. So picture a jockey. He's wearing the hat. The jockey is the sponsor. You need to make sure that jockey, that Maserati Mike, has got some kind of experience, has got some kind of credibility, aligns with your values. And Maserati Mike was 0 for 3 on that. He He had experience, but he had never done full cycle deals. And he just didn't align with my values. So focusing on the sponsor is the most important thing when you're investing passively. The problem is most passive investors, what do they ask? Where's the deals? Can I find a deal? That's the third step. The second step is the saddle of the horse, which we call the alignment of interests. Now, if I sat in that saddle and I said, me and Maserati Mike, we're really aligned because Maserati Mike is not charging me that much in fees, which he was. Maserati Mike has got some skin in the game, which he didn't.
Right.
And our alignment of interests were way off. They were way skewed. So if you're looking to invest in a real estate deal, whether you're partnering or you're investing passively, make sure that your interests align with your partner or the person sponsoring the deal. Then the third part, you're on that horse. The horse is the deal itself, which is what we call buy right, manage right, finance right. Don't even look at a deal if your interests don't align or if you don't like the sponsor of the deal. You're wasting your time.
Right. Right. Before you even get to the deal. I love that. That's such great advice because I think that, you know, a lot of times if you're looking at deals or deals can be presented, you're just looking at that horse, right? You're just betting on the horse itself. Like it's the best horse around. It looks great, right?
Yes.
But if you're not in alignment with the person that's doing the sponsorship, the deal will fail. It really will because the numbers can be perfect, but if you can't execute, and if you don't have those systems in place or the dynamic in place where it is set up for both of you to win, or if it's set up for worst case scenario, something goes wrong, that the person that you're with, you know, also has something going wrong for them because you want to be on the same team. You want to be equally engaged because no one is going to care about your money more than you do. That's just, they'll say that they do, but there's no way that they can if those mechanics aren't set in place with how the deal is being structured.
No, like, and trust is not a strategy. It's great. You know the person, you like the person, you trust the person. I would have been more comfortable if Maserati Mike put in 20% of the deal and that was all of his money and not had experience. Because when that deal goes south, Maserati Mike has a lot to lose and he's going to work as hard as he possibly can. But if you're investing with somebody who's got thousands of units and this is only like 100-unit little property, and if they lose the property, not a big deal. I mean, which scenario would you be more comfortable with? I think I'd be more comfortable with the first scenario,
Absolutely.
Knowing what I know now. And that's one of the things. Please make sure you are in aligned as far as your business plan, as far as what your goals are, as far as, you know, what you're looking to accomplish with that sponsor. That's truly important when you're investing with others.
That's right. So tell me, how do you, I mean, that's a lot of money and you're working in
It
restaurants.
is.
I know that it was not pocket change for you. How did you recover from that?
Well, that's a great question. I ended up buying a deal in November of 2006, year and a half after that, the second deal that you wanted to discuss, and I made more mistakes on that because I'm taking massive action. I've got more money saved. This deal, it looks like a shiny object. I made even more mistakes on this deal because we talk about the market cycle. I bought it in the wrong market. I bought the wrong market cycle. I overfixed it. There was no value on the deal. I just wanted to get back on that horse and find another deal and do something else. And that was a huge mistake. But from those two mistakes, it led me to multifamily and it led me to really to the mentorship aspect of it. Because I'm saying to myself, and no offense to any investors out there, but we're not a smart bunch. We really aren't. We're not rocket scientists, but we have a system, we have processes, we have a way of doing things, we have a framework, and it's repeatable and it's not that difficult, but I didn't know it. I always say my investing career is life before Jake and life after Jake. Well, you're hearing the life before Jake and the struggles and the trials and the tribulations and going it alone and not knowing what I was doing. Fortunately, when I met Jake, I had gotten the experience and the mentorship and I was ready. And when Jake and I started buying the deals, I had already experienced the pain and the mistakes. And if you're looking at this part of the market cycle right now, if you're in multifamily over the last 2 or 3 years, everyone was buying these short-term bridge loans and they were using those to buy these assets. Jake and I, and even in our Jake and Gino community, we forbid that. I'm like, I don't want short-term bridge debt right now because their interest rates are so low. It's not a matter of time before they go up. And what ended up happening, the Fed rates 11 times. And this is not from me being intelligent or anything. This is just from me losing 170 grand with Maserati Mike and me going with 2008 and just understanding that. I always tell people no deal is better than a bad deal. And I think if you live by that mantra and you focus on just doing good deals, and even if you only do 1 or 2 deals a year, By the time you're at year 5 or year 6, you've got 7 or 8 really excellent deals. That is life-changing,
It is.
completely life-changing.
Yep. I agree with you 100%. Best deals that I've ever done are the ones that I walked away from. I still think about them sometimes. And I remember how difficult it was to walk away at the time. A few of them I lost deposits on, but I'm glad to have lost a $10,000 deposit versus because one of them was including that type of bridge loan, and it scared the shit out of me.
Yes.
I was really looking at the terms and mapping out and modeling for the future. And I was like, if worst case scenario happens, I'm not going to be out just $10,000. I'm going to be out $100,000 and
Yes.
have a property underwater without finished construction that has a foundation issue. That would stop me for, maybe 5 years. So walked away from that. And it was hard because you feel embarrassed, or you feel like you didn't fulfill your end of the deal. But that's why you have due diligence. That's why you
Yes.
have the time to go through these parts of these terms and everything. So that once you do sign the papers at the end, you feel 100% confident.
Yes. And it's interesting. There's 2 ways that you go out of business in real estate, specifically multifamily. You run out of money or you run out of time. In your scenario, you would have run out of time because your debt would have come due and you would have had either to refinance or to sell. And if you're refinancing at higher rates and your expenses have gone up and your rent has slowed down like we've seen, you're in big trouble. Or if you're buying a 1960s asset at a 4 cap and you've got to add a tremendous amount of capital expenditures or budget to it, you may run out of money as well. So just be careful of those 2 caveats, running out of time or running out of money.
Yeah. And not just saying yes to anything just to make the deal work so you can get
Yes.
the work and the title turned over,
Mm-hmm.
things that will come up during due diligence. It changes the entire deal. When you come up going through the financing or going through inspections, you get a bid on a major capital expense that needs to be done before closing, and it's 3 times what you had estimated. That changes the whole deal. It's a different deal you're looking at now. And you've got to
Yes.
kind of reassess and not just keep pushing through because you want it so bad. Because maybe it took you a year to find the deal to begin with, right? We put so much time and effort into finding a good deal that once you get it, you almost do anything for it to happen, but can't make deals happen on wishful thinking. It's not how real estate works.
And that's why buy right, manage right, and finance right is so important. And I think you can use this in any niche in real estate. I mean, you picture a wheelbarrow. Jake's in his garage one day. He's looking at a wheelbarrow and he's like, wow, the 2 back legs are buy right and finance right. And the front leg or the wheel is the managed portion. So the managed is in constant motion. Once you buy the asset properly, it's fixed. Once you finance it properly, not with short-term, but longer-term debt, it's fixed. All you need to do is to manage that asset. And that's why you're saying the buy right criteria, it's important to nail it. Because once you've gotten a deal done and it's done properly and you understand what your criteria is, and you're not, as we say, pencil whipping a deal to make sure this deal works because you're fudging with numbers. You're making your rent, escalate at 10% instead of 5%. And your exit cap rate is a 5 cap instead of a 6.5 cap. You can make things look really good on paper. You have to be aware of that and be cautious of that, especially if you're raising money from investors. That's the key of it. I mean, it's bad enough losing your own money, but when you have investors in the mix, you need to make sure that your numbers are accurate. So focusing on the buy right and the finance right are important when you're taking a deal down.
Yes. Gino, can you go a little bit deeper into the buy right and finance right? Because I
Sure.
think it's very good key principles. And I want to know really, what do you mean by that?
So when you're looking at a deal, and it's interesting because the buy right is really affected by the market cycle. So I'll teach you another principle that we put together. All of these concepts are out there, but we package them together. We call it the 3 pillars of real estate. It's called the market cycle, the debt component, and the exit strategy. Now, when you're looking at a deal, you always make money in real estate, believe it or not when you buy, but when you sell or exit. Whether it's a sale or a refinance, cash flow is great, and we make money as cash flow. But people need to understand that's guru talk. I made money on the buy. No, you made money on the sell because you're crystallizing your equity and you're able to transfer that into another asset. But you need to understand what your exit strategy is. Buying real estate and holding it forever usually doesn't work, especially in commercial, because debt resets. Now, that may work in residential in certain areas, but you also have to understand is the market going to be the same in 10 years? Have you outgrown that asset? Because all of a sudden you're buying single family homes. Now you're buying 40 unit apartment complexes. So understand what your exit strategy is. And from there, you'll know what kind of debt you're going to get. If you're going to buy an apartment complex and flip it, you're going to buy shorter term debt. It's the same thing in residential real estate. If you're buying a home, flipping it, you're going to get different debt as opposed to buying an asset and holding it for the next, say, 10 or 15 years. And the market cycle is very important because that really helps you with your buy right criteria. When Jake and I started back in 2011, everyone was buying older assets because the prices were a lot cheaper and you were able to add value.
Right.
As it became a lengthier market cycle and things became more speculative, those older properties were getting more expensive to the point of, as far as cap rates go, they were very close to the newer assets. So myself as an investor, why would I want to buy a 1960s asset that's priced pretty similarly to a 1990s asset? The 90s asset, I can hold it longer. There's less work. There's less risk. So understanding where you are in the market cycle will help you create your buy right criteria. So when you're thinking about a buy right criteria, this can be the same in residential as well, or in RV parks or any niche. The first thing we focus on is the market itself. You can't be in 15 or 20 different markets, especially if you're starting out. Focus on one or two markets, start spreading it out and become an expert in that market. Start selecting how much median income you want. If you want apartments that rent for $1,000 a month, you need at least $3,000 a month in median income, at least $36,000 to be able to serve that $1,000 customer. It's 3 times the rent. What our number is, and it's different for every market, we like to see median incomes of at least $50,000. That denotes a pretty good tenant base because great, you've got a great deal. Are the residents paying? Are they creating damage to your property? That is something that most beginning investors overlook. I certainly overlooked it with Maserati Mike. From there, you got median income. Then you start filling out your buy right criteria more. In multifamily, what we're looking for is we love townhomes, 2-bedroom, 1.5 bath style townhomes. They're great. They feel like a house. If they've got garages, even better. If they got washer dryer hookups, let's talk about amenities, washer dryer hookups, dog parks, pools, clubhouses. We're looking for that kind of asset. We're also looking for brick. We don't like flat roofs. We like pitched roofs. It's not to say we won't buy something with a flat roof, but we got to discount that from the price. So you're forming your criteria. How many units? I mean, we'll buy anything. We just closed on a 4-unit property 2 months ago. It was next to our 12-unit. So we'll buy anything that makes sense to us, but anything up to 300 units. So let the broker know that. I think as you can get clear on your criteria, it's important. And then what ends up happening is the market cycle starts to shift. And also we're looking for newer assets in this part of the market cycle. As the market cycle shifts, we'll start looking at assets that are older because we can buy those at better prices. So you need to follow where the market cycle is, formulate your buy right criteria, and then just start talking to all your investors and to brokers and to everybody. Let them know what you're looking for.
Yes, I love what you're saying. Getting your criteria really, really razor kind of sharp can be a difficult thing to do when we have such low inventory and there doesn't feel like there's a lot of deals out there, and people will start to expand their criteria just because they really want to get a deal. If you were to talk to somebody now that's coming into today's market, and what we're dealing with, is this post-COVID kind of fallout a little bit. We've got much higher interest rates, although, of course, historically they're not that high, but no one really knows what's going to happen with them in the next 6, we're hearing all kinds of things. They are going to come down by the fall. It's going to be another year. We don't really know. So what would you say to someone new coming into this type of market looking for their first deal?
Interest rates really shouldn't affect anything. If anything, interest rates have dropped pricing because the cost of capital is higher. It's not only higher for Gino, it's higher for Kate and for John and for everybody else. So let's stop using that as an excuse, as a crutch. Let's start turning off the news because it's all propaganda. It's all to really, I guess, put us in fear. It's all there to just not make us take action. And I'm going back in 2011 and 2012, real estate was toxic. As you're listening to this, how many of you out there wish you had bought a deal back in 2011, 2012, 2013? I will guarantee you every single person will say, I can't believe the pricing. Well, we're entering that phase right now. And what I love about this phase right now is that when I pick up the phone and I call Kate, she's going to call me back because she's not as busy as she was 18 months ago.
It's true.
And I sign a confidentiality agreement and it's come into my inbox in the next 20 minutes. And when there's a call to offer on a property, there's not 30 calls to offer. There's not 30 offers. There's maybe 7 or 8. So right now, it's the time to start networking, creating your buy right criteria, talking to brokers in the market, building your, I would say, your infrastructure, your team, talking to potential investors. Because what you need right now is you need deal flow, you need investors, and you need networking. That's what you need right now. And if you're not focusing on that right now, when the market ultimately really bottoms out, which we never know it will happen, it'll be too late, because that engine is gonna have to start all over again. We're at the precipice of that happening. We know that end of 2022, we were at a high. Cap rates have started to decompress for the majority of the United States, and they're going to continue to decompress. It happened in '08. Cap rates from '01 to '08 really compressed. They really dropped. Once you hit '08, you could see the decompression going on to about 2011 or 12. And then about 2013, they started to compress again to around 2022. And in 2022, they're starting to really decompress. It's a function of interest rates and the interest rate cycle as well. Go back in history. So right now is the time. If you're serious about getting into real estate, now is the time, because the Kates of the world will take you seriously. They want to do business, and they're not as busy as they were a year ago or 18 months ago.
And I think I'm not sure if we talked about this while we were recording or right before, but how much, I hated those 18 months, 2 years ago, and you did as well. And I think it was because, the phone was ringing off the hook, but it was every 30 or 40 people calling me were not that serious. It didn't really know what they were getting into, but everyone was just rushing into the market. So now though, when I get a phone call or an email, I'm pretty sure that investor knows what they're doing, because they're so honed into what's going on there. They're ready to deploy capital. They have systems in place. They've got people in place. They know what they're looking for. It's making my life easier. So I don't have to deal with as many calls, but the calls that I do get are really good calls. I'm working with clients that know what they want to do, are ready to act when I give them a deal, and it's not as much noise. It's nice now, almost.
I agree. And as far as contractors, as far as being able to negotiate, as far as being able to hire A-star players, as far as being able to find property managers, maintenance techs, inspectors, plumbers, electricians, all of a sudden things have slowed down a little bit, and that's good for the market. It's like I said, it's function of the market cycle, and I think that's healthy. We have a boom, then we have a bust, then we have a boom, and we have a bust. That's how it goes, and you need to be able to buy real estate in any part of the sector. I would say this, and I think people need to hear this because it's important. You can buy real estate at any time. You cannot sell real estate at any time. You can buy it when it's going up. It's really hard to sell it when the market's going down and there's no opportunity. So understand that a function of the market cycle, if you're selling a deal right now, it may be a little bit more challenging. So understand that there are different strategies to buy real estate in different parts of the market cycle. You can continue to buy. Just be careful if you're trying to exit in a down market.
Yep, that's right. And I love what you were saying, that part of that pillar is your exit strategy. And I think that when you're discussing it, you start with the exit strategy.
Yes.
Right? That's where you begin at the end and work your way back. And then suddenly what you get to the beginning of it, which is your criteria for a deal, that is now come from the plan starting with the exit strategy. It's a pretty good start. And you're, probably starting out a lot better than a lot of new investors coming in just looking for that great cash flow, right? Or low price point or whatever it is that they're looking for criteria.
I agree.
Well, Gino, I'd love to hear what you're working on next, or what are you looking for? Throw it out to our listeners. How can they help you? How can they reach out to you? How can they contact you? Like, tell us what's going on.
Well, right now we've just signed on a 63 unit deal. It's a 2018 build. See, newer vintage, great part of the market. Median income is really high. This part of the city, we're in East Tennessee, it's blowing up. So we love all the indicators. Hopefully we've got another 67 units out as a letter of intent. We'll know tomorrow if the seller's taken it. If not, we're going to continue to look for deals. I think there's going to be tons of opportunity. We've got 1,700 units, so we're always constantly working on our systems and our property management systems, trying to build that enduring organization. And as far as the Jake and Gino community, our students have closed over 80,000 units. We do monthly events. We're out there just teaching it. And the reason is, it's pretty selfish on my part, to be completely honest with you, because it's amazing what I learn at every single one of these events. We just had a buy right boot camp, and to get 70 students in the room talking about their prospective markets, talking about what they're seeing, just confirms what we're teaching. And I'm actually picking up little golden nuggets. I've got a call with a company called Property Meld today on maintenance systems. We'll see how that goes. Never heard of the company before. I'm talking to companies for AI to integrate with property management. Probably would not have figured that out if I was just in my bubble and just renovating and operating these properties. So when people say, oh, I don't need the mentorship or I don't need the education, you may be right. All I know for the last 15 years, it's guided me to where I am now. And I continue to need that because the market evolves. And if you don't evolve with the market, or at least try to continue to grow, you will be left behind in this market. No doubt about it.
That's right. Well, how can our listeners find out more about you?
Oh, go to jakeandgino.com. You on our website, we have 3 or 4 podcasts a week. I have a how-to. I've got a show with my wife called Julie and Gino. We love talking about spousal relationships, communication, growing the family. We have the Jake and Gino show, and we have a show called Movers and Shakers that highlights our students closing deals. So go onto the website, Jake and Gino, and you'll get all the information there.
That's fantastic. And as always, all of this information is in our show notes. And Gino, it's been a real pleasure having you on the show today. I've learned so much. I love your energy and how you're able to take your experience and help others, because I think what a lot of people can agree on is if we all can do business better, it's better business for all of us. So if we can help share and teach those skills, we're actually bettering the market ourselves.
I love that. That is so right. A stronger passive investor will make a better general partner. The better general partner will attract stronger passive investors. And remember, people with financial intelligence can change the world for the better. If we're more financially intelligent, we can make better financial decisions, which will empower our futures. That's the bottom line, as far as I'm concerned.
It'll be more healthy, it'll be more sustainable, and maybe we won't have to go through such intense market fluctuations if everyone is coming to the table with the same general knowledge, skill set, and process and systems for doing this. We can all be successful. We really can.
You said it. I agree. Awesome. I love that comment.
Well, thanks, Gino, and thank you to our listeners. This is the Failures to Fortunes podcast. I am your host, Kate Berry, and we will see you next time.
Thank you for joining us on another episode of Real Estate Investing Failures to Fortunes podcast. If you enjoyed today's stories and insights, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us. Remember, your journey in real estate is a marathon, not a sprint. Embrace the failures, learn from them, and turn them into your stepping stones to success. I'm Kate Berry, and until next time, keep hustling, stay inspired, and keep turning those failures into fortunes. Happy investing.